Understanding legal structures and tax implications is crucial when starting a business. The type of entity you choose affects your personal liability, tax obligations, and how you raise capital. In this video, we'll explore three fundamental business structures: sole proprietorship, limited liability company, and corporation. Each has unique characteristics that make it suitable for different business scenarios and goals. A sole proprietorship is the simplest business structure where one individual owns and operates the entire business. There's no legal distinction between the owner and the business itself, meaning they are considered one entity. Setting up is incredibly easy with minimal paperwork required. The owner has complete decision-making authority over all business operations. However, this comes with unlimited personal liability, meaning personal assets can be at risk for business debts. For taxation, all business income passes through directly to the owner's personal income tax return. The advantages of a sole proprietorship include minimal startup costs and paperwork, making it ideal for testing business ideas. Owners have direct control over all decisions without consulting partners or boards. Tax filing is simple using Schedule C on personal returns. The structure is also easy to dissolve or change if needed. On the disadvantage side, personal assets are at risk for business debts and lawsuits. It's harder to raise capital since you can't sell stock or ownership stakes. The business automatically ends if the owner dies or becomes incapacitated. Additionally, owners pay self-employment tax on all profits, which can be substantial. A limited liability company, or LLC, is a hybrid structure that combines the liability protection of corporations with the tax flexibility and operational simplicity of partnerships. To establish an LLC, you must file formation documents with your state and create an operating agreement. Ownership consists of one or more members who can be individuals or other entities. The key benefit is that personal assets are protected from business liabilities. LLCs offer flexible tax treatment options, allowing members to choose how they want to be taxed. LLCs provide personal liability protection, shielding owners' personal assets from business debts and lawsuits. They offer flexible profit distribution that doesn't have to match ownership percentages. Pass-through taxation is available, meaning profits flow directly to members' personal returns. LLCs also require less formality than corporations, with fewer meetings and reporting requirements. However, there are state filing fees and annual report requirements that create ongoing costs. Members typically pay self-employment tax on all income they receive. Some states impose limited life provisions, where the LLC dissolves if a member leaves. The structure is also more complex to set up and maintain compared to a sole proprietorship. A corporation is a separate legal entity owned by shareholders, with formal structure and the strongest liability protection available. There are two main types. A C corporation is the default corporate structure that faces double taxation, meaning the corporation pays taxes on profits and shareholders pay taxes on dividends received. However, it offers unlimited growth potential and no restrictions on ownership. An S corporation provides pass-through taxation, avoiding double taxation, but comes with strict ownership restrictions, including a limit of 100 shareholders and only certain types of eligible owners. Corporations offer the strongest liability protection, completely separating personal assets from business obligations. They make it easier to raise capital through stock sales and attract investors. Corporations have perpetual existence, continuing even if owners change or pass away. Ownership is easily transferable through stock transactions. On the disadvantage side, corporations involve complex setup and maintenance with extensive documentation. C corporations face double taxation on corporate profits and shareholder dividends. There are extensive regulatory requirements including annual meetings, detailed record-keeping, and compliance filings. Formation and ongoing costs are significantly higher than other business structures. Selecting the right business structure depends on several key factors. Consider your business size and revenue goals, as larger operations often benefit from corporate structures. Evaluate your personal liability tolerance and how much risk you're willing to accept. Think about tax optimization strategy and which structure minimizes your overall tax burden. Consider your long-term growth plans, including whether you'll need to raise capital or eventually sell the business. It's essential to consult with legal and tax professionals to determine the best structure for your specific situation, as the right choice can save significant money and protect your personal assets.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.